The producer price index is cooling. April's print rising 2.3% on a year-over-year basis. That's the slowest annual increase that we've seen since January of 2021. So is this a sign that the Fed is slowly winning its battle on inflation? Joining us now, Jack Manley, JP Morgan Asset Management Global Market Strategist. Jack, it's great to see you again here. So I think every investor is looking at these inflation prints that we're getting, trying to gauge exactly what this means for the Fed. How do you think Powell and his team are looking at this number?
So I think the combination, Shauna, of the PPI print today, the CPI print that we got a little bit earlier, these are very good indicators for central banks right now, particularly Powell. We're seeing this story kind of unfold around the world, but of course the focus really being here in the U.S. I want to focus in on that CPI print in particular, and with that read that we got at 4.9% headline, that represents the 10th consecutive inflation read that is softer from where we were in June of last year. And one or two prints, that's not a trend. And of course, you can open up the hood and poke holes in these things, but 10 prints is a trend. And very clearly, there is a disinflationary trend that has taken hold in this economy. And I think that's exactly what Powell and the rest of the FOMC are looking for. So I'd say it's pretty good news.
So, Jack, with that said, what does that suggest on the next move for the FOMC? The expectation from the market, at least with the previous meeting or going into that, was a potential pause. The pivot has started to kind of recede to the back now. But what are we expecting later in the year?
So I don't think that the May hike was too much of a surprise. It was a little bit disappointing, frankly, from my perspective. I didn't think it needed to happen, but it wasn't too much of a surprise. Critically, though, we saw in the statement that was released alongside that rate decision some changes in the language there that kind of teed up this idea of a conditional pause happening as soon as June. So that is what my guess would be, Akiko, for what happens in June is the Fed decides that it's going to hold rates steady. Now, moving from there into the back half of this year, we know the market is looking for some pretty substantial cuts. Last I saw, futures markets pricing in around 75 to 100 basis points lower by the end of this year. The Fed's not telling us that, though. And you know what? To the Fed's credit, the market's been wrong every step along the way. So my guess is we get a pause in June, and then I don't think we really start to see cuts, at least not meaningful cuts, until sometime in 2024.
Jack, another big focus from the Fed, and we heard a little bit about this from Powell at the last meeting, was the stress that we're seeing play out within the regionals. We're seeing it once again today with PacWest. How are you looking at that stress and the implications that that could have for the broader economy?
I think it's very important when we're having conversations about the regionals to draw a very firm distinction between what's happening now and what happened back in 2008. These institutions may not always have the best risk management necessarily, but the loans that they are making are high quality loans. And in fact, the portfolios that they have are ultra high quality portfolios, treasuries, agency-backed debt. The reason you're seeing these problems is because rates have risen so quickly. Depositors are scrambling for higher rates, and these banks can't necessarily make up that difference because their high-quality portfolios have been marked down to market. All that's to say, I'm not particularly worried about the banking system right now. I think the Federal Reserve and Treasury have proven that they are willing to step in and backstop issues. FDIC as well. The large, too big to fail financial institutions have demonstrated that they'd much rather sort of help these banks out rather than allow them to go under. Now, that doesn't mean that the regionals won't face more pressure this year. I do think you're probably going to see a little bit more consolidation and certainly more volatility from an equity market perspective. But I am not worried about the health of the financial system. And it doesn't sound like Powell's too worried about it either.
So, Jack, you're not worried about the health of the financial system. From an investor perspective, though, is this a good opportunity? Could you argue that things have been oversold and maybe it's just a good time to get in?
Yeah, Akiko, that's a fair question. And honestly, I do like the valuation story right now when we're looking at financials. I also really like the net interest margin story when we're looking at financials, particularly for those larger institutions that have not had to pass on higher rates to their depositors. You get 1, 2, 3 basis points if you're lucky on a savings account, but your mortgage now is going to be north of 6%. There's a lot of money to be made there. But what I would say you have to take into consideration as an investor is whether you're looking at those regionals, the bigger banks, whether you're looking at any part of the equity market, the underlying focus has to be on quality. So you don't necessarily want to buy the index. This is very much a time for sector and even security selection.
Jack, outside of that, where else are you seeing opportunity right now? Because I think a lot of people, when they come on here, they're talking about the fact that we're likely going to trade within a certain range over the next 6 to 12 months. Are you in that camp?
I think at a high level, beta level, I think that's probably the case. I think this market's going to be choppy, and there's a very real possibility that it moves sideways, especially because multiples are a little bit richer than they probably should be, and because the earnings situation probably has not deteriorated as much as it needs to. But there are going to be pockets of opportunity in this market, and one of the things that I like to pay attention to within the sort of value or cyclical tilt that we've been more broadly applying to positioning is the energy space. I love energy right now. WTI is at $75 a barrel or so right now. I think that's too low. I think with China reopening, I think with OPEC flexing its muscles, I think with domestic energy policy not being particularly friendly towards fossil fuel companies and not necessarily incentivizing the reinvestment of any of these profits, energy prices stay higher for longer, and these companies are going to make a lot of money, and they're going to give it right back to you, the shareholder. So whether it's that story, the valuation story, I like energy in particular right now.
Where specifically in energy? Are we talking about big oil or something a little more downstream?
I'd say probably big oil, but I think the broad sector within the index looks pretty attractive, frankly.
All right, Jack Manley, always great to have you. Thanks so much for hopping on set here with us today. We hope you come back and visit us soon.